So it's a reaction to
Short
something
term.
that as it gets a little more logical. Should
Same
even
with
happen.
gold and silver. Oh, it's the only true currency.
Yeah.
Oh yeah, try buying anything with gold. The entire gold in the world would fit in one Olympic swimming pool in this darn hotel.
Yeah.
Don't tell me you can make gold in the money supply of the world. You'd have to have a microscope to measure it.
Right.
This is just irrational, emotional. It's the one currency. No, gold is a commodity, and when this economy goes down and China falls, gold's going to go down. Gold's already going down. We got people out of silver at 50. It's already dropped 40%. People think it's safe. The last time silver went to $50 was in 1980. It was back at $5 in 2 years. 90% decline. The US dollar is going to rise again, and eventually our bonds are going to rise in value. Right now I'm like, I want to wait until to see if the bond market reacts like Greece or Italy and says, hey, we're a little concerned, even though you're the biggest country in the world and the reserve currency, we're a little concerned that you can pay off all your debt. When that happens, then I'll tell people to buy treasury bonds. Right now at 1.7%, don't touch them. I'd rather be in treasury bills and be earning nothing.
Okay. Hey, I want to go back to GAO recently did a study about this transition of retirement income. And we don't have defined benefit pensions anymore in this country. And they're saying this is the biggest risk. We've never been in a period in this country where people are going to be converting hard assets to income, which is what we need to do during an inflationary period. Now, in the old days, it didn't matter because a professional was managing the pension, we hope, and we got our money the rest of our life. And if we had a deflationary period, heck, during the Great Depression, when prices went down, people that actually had pensions coming didn't suffer.
That's right.
They had an income, they just got to
That
buy more.
money would
and
buy
more.
more, yeah.
The people that suffered are people that lost their jobs, lost their income, and lost
their assets, yeah.
That's right. But now we have a situation where fewer and fewer people have pensions, and so that's becoming a threat to the actual strategy, which is you want to look for income. You want to look for income. Now I'm going to ask you about a specialty here, just because we deal so much in this. Page 234, you mentioned this, and I just want you to tell me what you know about it. Annuities with insurance companies can also be an attractive option during deflationary times. The risk here is similar to bonds in that you're trusting the ability of the payer or the insurance company to make good on the debt. Several insurance companies operating in the United States have been around for a century, including most surviving the Great Depression in the 1930s, so they have great track records for making their payments. In addition, with annuities, you create a payout on your money that matches your situation, such as a second to die or a period certainty. So in other words, if the husband dies, the wife is still getting a payout, et cetera, et cetera. You're pooling that risk. You're pooling the risk of like, hey, if a few of us spend our account down to zero, we're still getting checks. How do they fit into this?
Well, again, I mean, people look at AIG here recently and say, oh my gosh, the biggest insurance company went down.
Yeah, not from insurance.
That was not from insurance. They have collateral for their insurance. That was speculation in a small financial department that leveraged 50 to 1 and bet twice their net worth. That had nothing to do with their insurance part. Insurance companies are regulated. They have to have collateral, and they tend to invest in bonds. My thing is, yes, insurance companies are probably going to weather this better than the rest of the financial system. They do invest in stuff that's safer. You just have to make sure when you buy an insurance policy or an insurance-related investment that the insurance company's sound. That
You
they're
look
not,
at them on an individual basis.
Yeah, look at individual. Are they investing too risky? Do they have too much stocks in their portfolios and stuff? Because they can do that to some degree. But I do think they're going to do better. And again, they tend to invest in bonds, and over the long haul in a deflationary period like in the 1930s, bonds were the one winner. Stocks never won in the 1930s. You know, commodities didn't win. Real estate didn't win.
Plus they're leveraging up these bonds with just actuarial leverage.
Yeah. Yeah, I mean, they are scientific. They know when you're going to die. They're like us on
demographics.
demographic.
Actuaries with Coke bottle glasses that thick, I know.
No, but it's true. I mean, our demographic theory is the same as insurance actuaries. We know when people do things at their age. They know when you're going to die. We know when you're going to spend money, borrow money, but they know when you're going to die. So they're not taking weird risk. So they should weather this better. I mean, the rest of the finance, I'd be more worried about my money in my bank account than I would be about my insurance account.
So you mentioned in the book, under New Era Dawning, we have an opportunity that is rarer than once in a lifetime. It is more like once every 250 to 500 years to be part of a quantum leap forward. Explain, what's the opportunity and what is going to come of all of this that's going to make a better world?